If you minimize your losses, you're gonna have so many more wins.
Back in 2022, we didn't have proper mechanics.
Come back when the market returns to a normal state and you'll have a phenomenal year.
Tell me where I'm wrong, tell me where you agree.
Even though the premiums may be the same, one underlying has really high volatility compared to where it's been the last year.
Everything we do is a layered approach. We're stacking the deck in our favors.
How does it make you trade differently?
I'm starting to lean more and more bullish into this market.
I think we're going into a very bullish environment right now.
Don't bet against the market right now.
I think these initiatives are great for the American people.
Right now, you have Besson coming out, you have Hassett coming out, and they're all talking about
not to fight the market, not to fight the Fed.
I'm leaning more towards we got a good one for all of you today. We got a lot to cover. We got some Tesla, Nvidia drama. We got some crazy markets, bullish, bearish. We're going to talk about all of it. We're going to touch on what small traders should do. Small meaning smaller portfolios. Can they still trade? Can they still use our methodologies? How they can be successful? We got a lot to cover today, Greg.
Yeah, we do have a lot to cover. But before we get into that, let's talk about how we ended last week's episode.
Oh, okay.
So if you remember last week's episode, it was on the 2nd of January, or it was, sorry, Friday, the 2nd of January was the first trading day of the month, and then we recorded that weekend. So it would have been like the 4th we recorded, I believe. And at the end of the episode, we talked about how we both started out January rough. We both started out with several losses, which is unusual. But we started out with losses, and we said, by the time we film next week's episode, I bet we're going to be in the green. So I think we should update people on whether we're profitable now a week later.
All right. Well, why don't you tell us how's your week going?
Yeah. So now after that first trading day, lost 2 trades, won 1 trade. Now I'm profitable $9,000 for the month so far. After my Tesla covered calls continue to do well, my cash secured puts on Tesla continue to do well. As Tesla trades between this like 430, 450 range here, it just keeps making profit on both sides as it swings up and down over the course of the month. So yeah, I'm up $9,000 for the month. I'm not too disappointed about it.
Is that where most of that $9,000 came from, Tesla? Or
yes, but also at the beginning of the month, as we were talking about how volatility has expanded a little bit since the beginning of the year or into the beginning of the year, I put on several trades in different underlyings. I posted those on my X account at Greg Proctor. Some of them are Amazon. I forgot the list of trades I put on, but there's probably 5 or 6.
MU,
that's right.
I think you put on Baidu, maybe?
No,
Oracle?
Baidu was my loss at the beginning of the month.
Oracle, maybe?
I have Oracle on.
That's all I can remember.
Yeah, okay.
I know his portfolio better.
Anyway, so how's your month started after that first rough trading day?
Yeah, so after the 0 day that I took an L on, which would have been profitable if I just stuck to my own rules, but I got a little paranoid. I'm up about $7,500, $7,300
Nice.
for the month.
Where does that come from?
Meta, Tesla, Coinbase, and there was another one that I can't think of. Microsoft. So those have all kind of contributed a little bit here and there. Meta especially. Meta's been a really good instrument for me this past week, especially with where it's sitting at range bound a bit. So yeah, it's been a pretty good rebound.
Trading feels different this last week since the beginning of the year than it did December and November, doesn't it? In terms of volatilities, it seems like we're back in a kind of a normal volatility state. There's good premium out there. It just feels like we're back to bread and butter.
Yeah, I want to agree with you because you're probably right, but I still have a sense of paranoia because it's the start of the year. So my defenses are high
Yeah.
with that. So, at the end of the year, I think that paranoia was low because I was thinking Santa Claus rally, things are going to hold up. And, that pretty much did play out true. But now as we begin the new year, it's hard for me to maybe be objective without me trying to try to look a little bit ahead. So I'm always trying to look a little bit ahead, have some good market awareness, understand where things are going so that I can either be a little more conservative, a little more defensive, or so I can, take advantage in a good way. So you're probably right, but me trying to look ahead a little bit, it's hard for me to feel that way.
Right. I feel like you're like a beginning of the year conspiracy theorist. You're like it's the beginning of the year. It's a magical part of the year where something crazy is going to happen.
Well, it's been true for the past 5 years, and I would argue it's kind of playing out true right now.
Okay.
Tesla's down 10% from all-time highs. Meta's still down. We see what's happening with MicroStrategy, Coinbase. I would say the market is still trying to find itself right now.
Yeah, I see that. This reminds me, we did get a comment on YouTube. Last week we were talking about IVR, and the person was like, you're misunderstanding volatility. IVR is abnormally skewed because of March, April. Really what you should be using is IVX or IV percentile or something else. And I thought that was kind of a good thing to address very quickly.
Can I address it like an asshole?
Sure, go ahead.
Yeah, we have said that many times that IVR is overstated. Greg has said that many times because what happened in April, he's talked about the reset. So to whoever that person is, go watch our other stuff because we've touched on that. And then secondly, IVX is only pertinent to that given option chain, and IV percentile has the same problem where it's skewed because it's speaking two different languages. One's Arabic, one's English, one's Spanish across underlines, meaning different equities. So no, IVR is still the best choice, but you have to understand that what was seen as a high IVR last year, that may not be considered high IVR now, right? Last year, high IVR would have been 80, 90, 100. Today, high IVR might be 20, 25, 30. So we've addressed that. So it's just, to me, it's a little frustrating when I see that.
Here's a question that I've asked myself several times. If premium is high, does IVR matter?
If premium is high, does IVR
so
matter?
here's an example.
Yes.
Here's two companies I can think of. One is MicroStrategy. MicroStrategy has high premium right now. Volatility is not that crazy high. It was really high last year, but there's still great premium in there. Tesla's another one. We'll see Tesla at like a 13 IVR, and premium will still be phenomenal. And so there's the question. What do you think? Do you think volatility IVR is still? Do you think an underlying is tradable if it has high premiums but a low IVR?
Well, again, are you recalibrating to understand what high IVR is now? Because if you're not, then the question's not the correct question.
Right.
Right. So to me, right now, I think my mindset still works with that gentleman, lady mentioned. My mindset's still stuck from last year with how those levels were. And so to balance that out, just work an equation in my head, whatever the IVR is, I multiply by 5 or 6 so that I can kind of get back to where it would be. And so that's just kind of my back of the napkin math of how I think about it. So if IVR is sitting there for Tesla at a 20, well then to me that's kind of like 100. Mm-hmm. That's not really 20 of last year. That's like 100 of last year. But 20 of this year is like 100 of last year.
Yeah, and I think the way to think about that is the answer to the question in my mind is yes, an underlying is tradable if premium is high but IVR is low. But what you are afraid of is, will there be IV expansion? So if you take into account the skew that you're talking about, and the answer might be no, there's not going to be IV expansion, at least significant enough that it's going to hurt your position. But if you have reason to believe that it truly is a low IVR and not one that's just artificially low because of March and April, you should be hesitant trading that underlying. I think that would be my answer.
Yeah. Yeah. I mean, again, the premium isn't the thing I like to look at. It's obviously a factor, but I don't start with the premium because who's to say what high premium is? For you to say? Is it me? Is it just an opinion? Of course, it's just an opinion.
Well, I would say it's a range. I mean, there's a lot of underlyings that have very low premium. You can't get very wide. You only have maybe 3 or 4 strikes on each side that have any premium at all on them. I think we know what low premium is.
But I guess what I'm saying is that low premium that you're referring to is in relation to that underlying. Right? So is it high or is it low? Again, to me, is opinion based. Palantir, people might think has a low premium if you look at it right now. But for Palantir, it might be a high premium. And so it makes sense to sell it, right? So that's why I don't like just looking at the premium. I like looking at something that I can measure across different stocks, different component, different underlines, so that I can make a informed decision rather than saying, well, $5 here, that looks like a lot to me, but $5 is nothing for Costco. It's a lot for Tesla. So you need to have apples to apples comparison. That's what IVR helps you do. It helps you understand where is the volatility. Even though it's skewed right now, if I see a 20 on Tesla and a 15 on Costco, I know 20 is higher than 15. And I know we're speaking in an apples to apples comparison. So it points me in the right direction.
And so the way, just to kind of summarize what you're saying, how you compare them apples to apples is because you're using the same formula to look at the volatility of an underlying compared to itself over the course year, you can then take those two ranges and say, hey, one underlying has really high volatility compared to where it's been the last year. The other underlying has a low volatility compared to where it's been last year. Even though the premiums may be the same, the one with the high volatility compared to where it's been the last year is less likely to have a volatility expansion, and therefore you'll capture that volatility decrease and that premium contraction. There's a higher likelihood you'll collect that premium contraction.
Yeah, exactly. But if I was looking at it strictly from a lens of which one has more premium, I could screw myself over.
Yeah, you might decide to trade the one that actually has a lower IVR and is more likely to experience a volatility expansion event.
Correct. Yeah, and this is, a lot of the philosophy behind the options crash course is, everything we do is a layered approach. We're stacking the deck in our favor. So it's not just one thing. It's not just premium. It's not just volatility. It's not just this or that. It's a whole series of events. We're trying to line up the Swiss cheese holes to give us the highest likelihood of being able to just go straight through into profitability. So yeah. But let's
enough on that.
Yeah, we probably lost everybody. Let's kind of reset a little bit here. I want to talk a little bit about a theme I kind of had last week, and I want to expand upon it, which is don't bet against the midterms. And what I say about that, really what I'm saying is don't bet against the market right now. And so I want to set this up and see what you think about this, but really at least share with everybody else my opinion right now about the market. And it leads into how I'm trading, how I'm choosing to be skewed one way or the other, sell puts, buy calls. It sets up my framing right now. So when I say don't bet against the midterms, right now, we need to understand that the market is pretty healthy. The market's actually really healthy. All right. We've seen unemployment's been rising. The unemployment rate's been rising literally every single month for maybe 7-8 months now. Until this last jobs report that came out on Friday, unemployment dropped from 4.5% down to 4.4%. All right. I've been calling this on Randy Kirk's show, on with Herbert. I think I started saying this at the beginning of December, that I think that we have peaked on the hiring or the increase of unemployment rate. And so this is the first signal to kind of prove my thesis correct. So that's one thing. The second thing is we have seen the Atlanta Fed, who's considered like the most accurate with predicting GDP. They've now bumped up GDP prediction for by the end of Q4 2026 to 5.1 to 6%. All right, to put that, what does that mean in context? Only countries like China have a 6% GDP. So for us, a Western, long in the tooth type economy, we don't have a lot of unknown growth, like from, people who are, in poverty or out in the farms, right? They have a whole population of people that are being uplifted through whatever bits of capitalism they have. And that's helping them grow their economy, right? So they're still kind of in this weird middle of the internet age, industrialization, right? So they have a lot of potential growth that they're tapping into. We've kind of exhausted all of our obvious, and so we have to find new ways. That's one of the things about the United States that's unique, is that we can't look to the rest of the world for tapping into growth for our economy. We have to create it. Silicon Valley, internet boom, AI, right? We have to constantly do that. So we are seeing the Atlanta Fed predict a 5 to 6% GDP. That's huge. That is literally insane, all right? Rate cuts have dropped for expectations in January from 15% expected down to 2%. Why? Again, unemployment ticked down. That's a big deal. Trump is now asking Fannie and Freddie to buy back $200 billion in mortgage bonds. What does that mean? Bonds are complicated for people to understand. So if Fannie and Freddie go and they buy $200 billion worth of these bonds off the market, that means that there is less supply of it. If there's less supply, that means that demand will go up, all right? If demand goes up, that means that the bonds don't have to offer as high of a yield in return in order to get those bonds purchased, which means interest rates come down, all right? So that is very bullish, and that's essentially a quantitative easing for just the housing market, for just mortgages, right? It's honestly a very brilliant move. Again, hate them, love them, whatever about Trump, it's a clever move. It's probably a Besant idea, to be honest, but clearly Trump's signing off on it. It's a great strategic move. And as a result, over the last year, including with all the rate cuts we've had, we have seen mortgage rates go from 7.15% to, on Friday, they ticked down to 5.99%. That's huge for the economy. In 1 year, it made that drop, all right? And then now we see Trump on Friday again announcing, or yesterday maybe, announcing that he wants to have a 1 year cap on credit card rates at 10%. All right. This is a guy who is fighting to make sure affordability is had before the midterms. He is doing everything he can to ensure that when he goes into the midterms, it's not because of affordability. Like I said, he's focused on housing. He's keeping oil prices down. He's trying to cap credit card spending. So with all that, and I'll throw one other one in there, he needs funding from Elon. He needs to make sure that there's no tiff between him and Elon going into the midterms. Otherwise, they're screwed. They can't replay what happened last year. Otherwise, Trump's gonna be screwed. So, and he needs the backing of Elon, the funding, right? What does Elon need? Elon needs NHTSA to go ahead and push through federal regulation for autonomy. By the way, there's a hearing coming up on the 13th. We'll talk more about that later. And so it behooves Trump to help Elon pave a way to get what he needs by April when Cybercab production starts, right? So you guys see how all this is kind of lining up? And so for those reasons, I can't stress enough, don't bet against the midterms. I'm not talking about the midterm outcomes, but don't bet against everything that's going to be done leading up to it to make sure that the stock market is soaring, that affordability is better than what it is today. And for those reasons, I'm starting to lean more and more bullish into this market. This is a working theory. We'll see what happens. But as of what's today, January 11th, when we're recording, this is kind of how I'm thinking about it. I've said a lot. Give me some feedback. Tell me where I'm wrong. Tell me where you agree. Tell me if any of that changes your mind about anything.
I think that was a great summary of what's going on right now, Nick, with Trump and his strategic plans for the midterm. I think so. I mean, love or hate Trump, I think these initiatives are great for the American people, right? We want credit card interest rates being capped, great for the lower and middle class. Unemployment down, great for the stock market, great for people as a whole. That's indicating that companies are doing well, that they're spending a lot of money on hiring and employment and technology. That's all great. So I think that's extremely bullish for the American consumer, American public. It should be extremely bullish for the stock market, like you said. And that should be great for options traders like ourselves. When you view what's going on through that lens, how does it make you trade differently as somebody that's saying, hey, I think we're going into a very bullish environment right now?
Yeah, so I'm leaning more towards bullish positions. All right. Now, that doesn't mean I don't have any short calls right now. I do have a few. I've got on MU. I've got on Microsoft. I have a remaining few covered calls on Tesla that will be going away, I think, this week. But I'm not placing any new trades that are either neutral, meaning balanced, or that are saying that there's not that much risk to the upside.
So you wouldn't be putting on a strangle right now?
I'm. It's not that I wouldn't. I am not putting on any strangles right now. I am purely looking for companies that are set up to move higher, because my biggest fear. I didn't even get through everything here. Right now, you have Besson coming out, you have Hassett coming out, and they're all talking about June, new Fed chair could easily do a 100 basis point cut on rates. Like, do you really want to get in the way of more of that talk, more of that rhetoric?
No, and I think we've learned
Not to fight the Fed.
our lesson so many times not to fight the market, not to fight the Fed. Let me just back up here for a second. So in 2020, when was it 2021?
2022.
2022, when the Fed started raising interest rates, I was stupid enough to fight the market there and certainly regretted it over time.
Let's just be honest, okay? Let's be very honest. We were not fighting the market. We were not fighting the Fed. We were both oversized in bullish positions, and we are fighting ourselves, and we are fighting the pain of taking a loss.
Yeah, we were fighting the pain of taking the loss. We were also very optimistic on the stock that we were heavily invested in.
Naively optimistic.
Optimistic, but it goes to the lesson there is even if a company is doing phenomenally, even if their technology is revolutionary and they're profitable and all that, if the Fed is doing something to limit growth in the economy, like raising interest rates, what the Fed is doing is going to outweigh what that company is doing. And that's what we mean by fighting the Fed.
Yeah. I'll also add, and I think this is fair. You know, we're both in our 30s. Some of us closer to 40s and others. But I will say we were also inexperienced to have such a strong Fed monetary policy with these rate hikes. We haven't seen rate hikes like this in our lifetime. Has never happened. Last time was in the 80s with Paul Volcker. So we were learning in real time as well. I mean, everything else is true. We should have taken a loss sooner. We were overly optimistic. We weren't seeing the signals that were very right there in front of our face. It was very obvious. But at the same time, we had never gone through something like that. Most people who were born after the 80s had never gone through anything like that. So it was also pretty, it was just new to us, right? Like you see these rate hikes happening, and you think back to 2018. Okay, well, that was just a handful of hikes. You think even back to '08. Again, that wasn't that many hikes. It wasn't we went from zero all the way up to like essentially just under 5%, right? That is, I think, a bigger increase than even during the 80s, right? So we'd never seen something like that. And I think just to, I don't know, I guess balance it out a little bit, we were learning and we've learned from it. And so now we look at things through a different lens.
Yeah, and another example of that was the tariffs in March and April. I know we've talked about it several times, but that's a good time where something happens geopolitically, which is a little bit relevant to today with Venezuela and potentially Greenland. There's some macroeconomic things going on that could affect the stock market. So it's smart to keep that in the top of your head. When something like that happens, Fed starts raising interest rates, or there's some significant tariff disputes, and the market starts behaving in a way that you weren't expecting, that's a good time as an options trader to say, all right, let me close out my positions that are risky. Let me sit out for a few days or a few weeks. Let's wait till this calms down. Because what we've learned as options traders is if you minimize your losses, you're going to have so many more wins, profit than losses, that the smartest thing you do is just sit out those times. Just minimize those losses, play it smart, come back when the market returns to a normal state, and you'll have a phenomenal year.
Yeah, no, that's well said. I mean, I think the biggest thing that it's a nice thing that we have three of us that are in a group and we constantly iterate and keep each other accountable. But I think one of the things that we've learned the most is that in those crazy times, one, you're going to find out if you were too big in any position, right? You're going to find out quickly. And, we've learned our lesson too many times. I would also say that strategy, I think we've gotten a lot better with our strategy. During those uncertain times, it's not necessarily that we're just saying, oh my God, run to your portfolio, close every position out. But it's more, hey, is something making you feel uncomfortable? All right, maybe just close that one out. Maybe leave the rest on. Okay, as those, get closer to time to take profits or to close them out, but maybe you're not necessarily putting on new ones just yet. Maybe you're just slowly scaling down as an opportunity presents itself, and then you're waiting for things to not necessarily just go back to complete normalcy, but to understand what's happening. So like with the whole Venezuela thing, I didn't do anything right out the gate. And after it happened, I saw how the market was reacting. Market was actually reacting bullish. I was like, okay. So I put a little bit out there. I didn't put too much out there, but I put a little bit.
Yeah. No, I think that's smart. And that is why mechanics are so important, really, because we have managing and closing mechanics. And so when you're in a state like that, you can wait till those mechanics tell you to close those positions. You close them out as you need to. And like you said, maybe you wait to put on new positions until you have a little bit more clarity about what's going on in the market.
You know what else we didn't have back in 2022? We didn't have proper mechanics.
No.
We didn't know how to ring the bell. We didn't know how to say, hey, we've taken X amount of loss. Yeah, it sucks. It's going to hurt. But X plus 1 is going to hurt even worse. Yeah. So that's something that we have learned. I would say that's the history. That's a lot of the lessons learned that goes into a lot of the strategies that we have as far as staying mechanical. And luckily, anyone who hasn't traded before, they don't have to go through those mistakes, right? They can learn from us and how we, how we operationalize it so that even if you're extremely bullish, you can take advantage, or you can not do certain trades to get in your way and be a little more defensive when it makes sense to.
Yeah, and we're always continuing to learn as well. Like with our trading group, we just had our end of the year options dinner with our group, and we all brought in topics of things like the biggest lessons we learned in that last year. And a lot of them were staying small, like, don't trade too large. It was minimize losses when they occur because most trades are profitable. Things like that. We're continuing to learn, continuing to refine, which is the importance of having a trading group and being able to bounce ideas off of each other, adjust mechanics where needed, things like that.
Yeah, what was interesting is I think across the board, the common lesson was that we got hurt every time we tried to trade too big.
Yeah.
Or not every time, but when we did get hurt, it was because we were too big. I think what happens is you have a good month, you have another good month, you have another great month, you have a fantastic month, and you start to get a little loose. And right when you're starting to get loose, that's when you get caught. All of a sudden, like, oh, what'd I do? I know better than this, right? Even us, we've been doing this for so long, but even we make this. Tom Sosnoff, right? He's kind of one of the goats of the space, innovator, created Taste Trade, created Thinkorswim, foreign market maker. Even he got caught at the end of last year on an Oracle trade, went way too big. Earnings came out, didn't blow him up, but he's, I don't know, worth a few $100 million, if not a billionaire. But even he still made that mistake, right? And he even came on air and he was saying, I know better. I knew this was gonna happen. Like, of course it happens. The one time I decide to, go bigger. So that's where mechanics are so important.
That's right. And it's also, that's why treating trading like a business is so important as well. Because if you don't reset every month and say, at the beginning of the month, I start at zero, my goal is to be profitable for this month. If you don't take that approach and instead you just accumulate your wins over the year, you'll get to a point where you're like, I have so much house money here. Yeah. I've made so much money that I can, and I'm up 30% of my portfolio, 20%, whatever it is. I can start being a little looser. I can start gambling a little bit more because I'm playing with house money. And that's when you go from being a profitable trader to being a trader that's taking on too much risk and ends up not making any money.
Yeah. And luckily that hasn't happened to us. I think it's, again, because we keep each other accountable.
Yeah.
So Greg, with everything I just said, are you feeling as bullish about the market as I am, or do you have a different sense of it? And if you do one way or the other, how are your trades setting up? Are you starting to put both sides on? Are you being directional at all? What's your current framework?
Right now, I'm pretty delta neutral.
Okay.
Meaning I'm not taking a bullish perspective on the market, but I'm not taking a bearish perspective on the market. I agree with everything that you're saying, but I think we're talking about a six month window of time. I think the market is going to continue probably to go up over that period of time leading into the midterms because of all the great points you brought up. But I'm also concerned about, and I know we're going to talk about later, but I'm also concerned about what's going on in Venezuela, in Greenland, and the potential for economic shakeup there. There's also some other things now we're going to talk about, like the tariffs, the Supreme Court hearing on the tariffs and stuff. But all that can affect the market and cause turmoil, additional volatility. So that's the reason I'm staying mostly neutral. I do have some positions on that are bullish. So I have a mix of bullish and neutral positions, but I'm certainly not taking a pessimistic view of the market at this time.
Can you give us one of your bullish positions? What does that look like? Is that a leap? Is that a short put?
Oh, okay. That's what you're saying.
Is it in Meta? Is it in Tesla?
Yeah,
just give an example.
So I'm not sure what underlyings they are, but I have several that are just short puts. I do have some long calls on right now, but I don't have them on for.
Let me pivot a little bit here. If I'm watching this, I imagine that people are going to ask, what do you mean you don't know what underlines? Maybe you could talk a little bit about how you can trade and have a position on where you don't necessarily off the top of your head know what the underline is or what the company is. How are you able to do that?
There's several reasons, and they're all unique. So Nick is a little bit more focused than I am on what's going on how things in the marketplace can affect his trades. There's another cohort of people that don't care at all about what's going on in the market. That don't care at all. I mean, literally, they don't look at charts. They don't look at the news. They just see, is IVR high? Is, are my other conditions met? And I'll put on a strangle. Or if I have a position, like I happen to be fond of Tesla and I think it's gonna go up, I'll just put on, a short put and not a short call. I'll be bullish on those trades. I am, despite Nick's finger pointing, am somewhere in the middle. So for me, like, there's reasons outside of the market why I would just put on one side. If we're going into earnings and we have by going into earnings, I mean earnings are within the next 3 weeks, and I can see the stock has been appreciating for the last month, I'm not going to put on the call side because there's going to be anticipation and excitement going into earnings, most likely. The stock is trending upwards. I'm not going to fight against the market there or fight against that underlying and put on the call side, the short call side. And if I do, I'll put it at a much lower delta. So I'll make decisions based on when earnings are, what the stock chart looks like sometimes. If it's got, mostly it doesn't affect my decision making, but if it's got, if you're looking at Nvidia over the last 3 years, it was putting on the call side a good idea? No, it's going up and to the right for 2-3 years in a row. So there are things about the particular underlying that may cause me to just be bullish or just be bearish or to be delta neutral. And there are things in the market that'll cause me as a portfolio wide to be a little bit more leaning towards bullish, bearish, or neutral. But there's a lot that goes into each decision.
Yeah, no, it's fair. I mean, I don't disagree with what you're saying. I think I tend to care a lot more about what's happening and having good market awareness, because let's just use your example. If there's earnings coming up, maybe you just sold the put and you're not aware that, well, there's a jobs report coming out, there's a Fed meeting scheduled for Wednesday, and these 3 Fed speakers that tend to be the more hawkish ones who don't want rate cuts are going to be the ones speaking. Who cares about that earnings or what that could happen? Like, that alone could send that position down. If I'm already up 20% on that position, I'd rather just take that position off, knowing all that craziness is probably going to come into the market. I'd rather just take it off before dealing with any of that. And so to me, it helps me inform when to take position off, knowing something's going to happen. If there's a Fed meeting coming up, sometimes I'll wait till the last minute before the Fed meeting actually starts to take a position off, just to let more time decay kick in. So that's how I try to gamify it, but I don't think there's a right way or wrong way. It's just whatever your working framework is, as long as you're consistent with it, I think that's what matters at the end of the day. But I only bring this up just to show that there's different approaches, and you're right. There's someone to the right of you that doesn't even care about any of it. I don't really believe them, to be honest, but they say that they don't do anything, they don't look at anything, they don't care about anything. I'm like, okay.
Consider me a trading moderate.
Well, we know I'm not on the left over here, so.
Yeah, the YouTube comments certainly indicate that. Not just kidding. But sorry, one thing that I have to throw in there is if you're trading 0 days in SPX or 0 days in any underlying, you have to be aware what's going on in the market. Before I started trading SPX, well, that is so different than a 45-day trade. You have in a 40. So what we were talking about there are trades where we put on somewhere around 45 days. You have a lot of time to be right or wrong. You have that trade decaying over a period of weeks before you need to get out of it. 0 days are much different. 0 days, you have to know if there's a Fed meeting that day.
They're not forgiven.
You have to know if there's some other economic event, if Bessett's speaking or the Fed chair speaking, or there's a job print or an employment print, because those things significantly affect your probability of success in 0 day trading. And it can get you in trouble if you do not know what's going on.
Yeah, that's well said. Yeah, I would say 45 days can be forgiving. They move slower. You can adjust. You can get defensive. And the inverse is also true, right? Everything we're saying, we're talking about the negative potential outcomes, but the opposite is true as well, where you have positive outcomes because of these things. But we like to focus more so on the risk because we always want to be aware of what's out there. There's this rock climber, Alex Hordell, something like that. I can't remember. He's a free solo climber.
The famous one.
Yeah. But what he said, before he ever climbs a face or anything, he does it, strapped up and everything. Using horrible words here.
he's going up there, guns loaded.
Yeah, but he will climb the entire face, and while he's doing it, he's constantly thinking with every single hand placement, every foot placement, what happens if I fall here? What happens if I fall here? As he gets higher and higher. And the reason he does that is because when he's finally ready to actually do the free solo, he says, I can't be on that mountain halfway up and all of a sudden for the first time having the thought, what happens if I fall? What happens if I slip here? That's not the time to be having those thoughts for the first time. And that's why we are so overly emphasizing mechanics, having your rule sets. You'll see when you join our options crash course. The next one's on the 31st of January, but you'll see we stress this so much of understanding what's going on, what you're going to do, never placing a trade unless you know how you're going to get out for that same reason. Because when things are going against you, it's not the time to be trying to figure out, how do I manage this, Greg? How do I get out of this? That's the wrong time. It's too late.
Yeah. And that's important in 45-day trades or bread and butter, but it is so much more important in 0-day trades.
Yeah. If it's true in the 45 days, the 0 days just make it an extremely obvious point.
Yeah. The only time a 45-day trade feels like that 0-day trade when something's going wrong, it's going wrong so quickly that you have to have mechanics. Otherwise, you're not going to know what to do in that situation, is something like March and April. Like March and April kind of felt like that as well, where it's like, oh man, we have a 10% intraday drop in SPX and all my underlyings, Tesla, Meta, whatever, are all taking a 10% plunge as well that day. You have to know what to do on those days.
Yeah, well said. Let's move on to the next topic. I didn't want to spend too much time on this, tariffs. I just more so want to touch on it just so that everybody watching this has a little market awareness. On Friday, we did not get the Supreme Court's decision on tariffs. If we would have, it would have been at 10 a.m. The next chance where the Supreme Court will release the decisions that they have for whatever cases they decide to release will be on Wednesday. So be aware of that. On Wednesday, there's potential where that decision comes out. I don't know if the stock market will go up or down, if they announce it or what they're going to say. It's just a kind of binary event worth noting that isn't normally on the calendar. It's not like a Fed meeting or jobs number. This is, a little bit androgynous, I think is the right word. That's not on your normal docket. Yeah.
And just to add a few points to that, I'm an attorney, I'm a litigator, and I can tell you decisions from the courts of appeals or the district court to the Supreme Court, you never know when those are coming out. I mean, they could take weeks, they could take months. Courts dockets are extremely, extremely busy. In terms of the substance of it, I know you want to just hit this lightly, but we have right now a 6-3. So there's nine judges on the Supreme Court, with Judge Roberts being the chief judge. We have 6 conservative judges, 3 liberal judges, and typically conservative judges tend to give the executive branch, the president, more flexibility on expanding its powers. So I feel that the Supreme Court is likely to come down on the side of Trump using these emergency authorities to impose tariffs for national security reasons. The last 3 presidents before him, Obama, Biden, George W. Bush, they've all used the exact same powers to a smaller scope. And the use of those powers have been challenged in appeals courts and at the Supreme Court several times before. Most of the time, the Supreme Court decides not to take up the case. The way that it works is you take something to the district court. If you don't like the outcome, you can appeal to the Court of Appeals for the Federal Circuit. They can determine whether they want to accept that appeal. Typically, they do. And then if you still don't like the decision after that, you can take it to the Supreme Court. It's called a writ of certiorari. And the Supreme Court decides whether they want to consider the issues in that case. And typically they're only considered if they're of significant weight in the United States. And so here, obviously, they decided to take up the case, which makes sense. But still, given the 6-3 split, conservative to liberal judges, I would think that more likely than not, the Supreme Court is going to allow Trump to do what he's doing with tariffs right now.
So I'll just give my opinion on it, and thanks for laying that out. I don't know if you guys knew that's how it all works. I've had the benefit of being friends with Greg, so I've heard this many times, but it's always good to understand how the process works. With regards to the decision, I don't think it's going to be a yes/no kind of thing. I think there's going to be some points that the administration is going to lose on, that they're not allowed to do certain things. They might put a time limit on it, how long they can be in place for. They might, I don't know what they're going to do, but I think they might give certain avenues where Trump can keep doing what he's doing. But at the end of the day, I do think the decision will be more in favor of the administration to do what they're doing, just for the simple reason that if the president's allowed to embargo an entire nation, that is the most extreme decision you can do, trade with a nation. So a tariff is a lesser degree of an embargo. So I don't understand how a president could embargo an entire nation, but he can't put a little embargo on them. Like that doesn't, like, I would love to understand the rationale of the decision when it comes to that. So to me, I think that kind of, when you think about that, to me, it's kind of a checkmate thing. Now, you can say, like, and I don't know the authorities the president has for how long they can embargo a nation, but I also do agree with what you're saying as far as they are more conservative judges. That's probably going to be friendlier to administration. Trump has appointed several of them, but I do think that they will be objective. I know that's kind of hard thing to think about today in this political climate. But I think they have remained pretty objective, even with like the, help me out. What was the
Roe versus
Wade one? They didn't rule on it. They just put it back to the states, right? They didn't say one way or another, which they could have as a conservative Supreme Court. They could have just said, hey, this can't be done, right? Like they could have found a way to do it because that's their bias. But instead they said, we're just going to give it to the states. That's where it should have been all along. This is a state's decision. Each group of people should make their own decision. They should vote on it. To me, that's kind of a little litmus test that they are somewhat objective. But I think that's how it's going to go down. I think that there will be certain avenues. I think there will be certain restrictions. What I don't like is kind of the politicization of this. Biden didn't take any of the tariffs off that Trump put in his first term. He left all of them on. No one took a single one off, right? So it's like, this is, and I get the severity of it was on a whole nother scale, but I don't know, like clearly all the doomsdayers, what they thought was going to happen, didn't pan out. And I know I don't have it on the docket, but before we get into talking about Greenland, Venezuela, and all that, and how that's affecting our trades, do you have any point of view on all of the doomsdayers out there right now with the markets and what they're saying? I don't know if you're seeing any of the stuff that is being put out there.
I mean, I was thinking about this the other day. There's been doomsdayers on the market since I opened up my first brokerage account when I was 18. Again, it just doesn't go away. So I'm not sure what specifically you're talking about, but do you want to fill us in what specifically you're thinking about?
Yeah. So, I mean, again, I think a lot of times people are talking their own book, and that's why they have certain points of view. But right now, you have a lot of people talking about how, last time we saw this amount of truck sale, like semi-truck sales decline in relation to how the S&P's gone up. 6 months later, we have 2008. 6 months later, we have 2001. 6 months later, we have 2022. And you see a lot of these examples. You see the people talk about, the whole GDP to debt ratio. You hear people talk about how many years in a row the S&P 500 has been up, that we're due for it. You hear people talking about tariffs, right? How tariffs are going to set us. We've been hearing that we're going to be in a recession since 2022?
Yeah, that's all noise, not signal to me.
I agree with you, but kind of my litmus test is when I hear all these people, especially it's nonstop about drawing the similarities to 01, 08, and 2022. It's crazy to me how many. But the one thing that they all seem to leave out every single time is that for the 01 market drop, for the 08 market drop, for the 2022 market drop, all of those were in a Fed rate hike cycle. None of them were in a Fed rate cut cycle. And everyone conveniently seems to leave that out. And so is it that simple to just don't fight the Fed? Is it that simple? Even in the Great Depression, if you guys read Andrew Sorkin's 1929, what triggered it? The Fed raising rates once again. Yeah. So 1980s, what was it? Fed raising rates once again. So it seems to me like this is a very important data point that you don't want to leave out. And so when Fed is raising rates, I mean, like we said before, don't fight the Fed. Probably get defensive, but when they're cutting, I think it's a fair game to say, be cautious but optimistic.
Ride the Fed's wave of lower rates. Yeah.
So let's pivot into, I guess, the geo.
You talk about Greenland?
Yeah, let's talk about Greenland, but wherever you want to go with it.
I think it's really interesting what the Trump administration is doing with Venezuela and Greenland. So Greenland has one of the largest deposits of rare earth metals, along with a lot of other natural resources. And so when you look at what's happening with Venezuela and having an extremely large oil deposit, and now Greenland having having a significant rare earth metals, which is extremely important to technology growth, because we're talking about electric vehicles, we're talking about batteries, we're talking about electrical components. Those resources are extremely valuable. And we're in this geopolitical environment where we have aggression from the Russians in Ukraine. Maybe that's old news now, but we have a lot of turmoil there. We have had tensions between the United States and Russia when we were supporting Ukraine. Now it seems that there is interest from the Russians in Greenland and those natural resources, as well as there was in Venezuela. So this seems to be, Nick, you might have a more articulate explanation of this than I do, but it seems like Trump is strategically placing the United States to take advantage of the oil reserves in Venezuela and the rare earth metals in Greenland as a national security measure. And I think that people have concerns about the expansionism of the United States in this regard. I was watching a podcast on Patrick Bet-Davis, and he was reminding people that, now this isn't a good thing, but the United States was founded on expansionism, to be honest, right? They
You don't think that's a good thing?
I think there's you could go either way with it. I think the end result of the United States being expansionist in the late 1800s, early 1900s resulted in a great thing, right? Resulted in the United States, resulted in stability for the world. At the time, was it great? Was it great for the people living in the places that were more or less conquered or were purchased? Florida was purchased, California was purchased. Is it good for those people those times? I don't know. So I think there's going to be people have a lot of opinions on that. What do you think?
So let's take a step back. I think what's happening here is we have a huge global power. I don't think it's a struggle. I think we clearly are the power of the world. But we have a tension between China, Iran, Russia, and the United States. And when I say United States, really, that includes the rest of the Western world and Australia and Japan and Korea, right? All these other countries that are allies of ours, includes them. Why? Because we protect all of them. Nobody messes with Japan. Nobody messes with Australia. Nobody messes with Taiwan because of the United States. And, people are very quick to have their opinions about expansion's bad, all this, but they don't see the bigger game at play, what's on the chessboard. Yes, Venezuela has a lot of oil reserves, and yes, and one of the biggest gold deposits. Yes, Greenland has a lot of natural resources, rare earth metals. That's great. But what's the real play? Why is that really important? Well, it's important because China is trying to choke the entire world by limiting what people can do, because China refines most of the rare earth minerals in the world. All right. Iran, Russia, and China were all setting up in Venezuela, have been for years. Russia is, one of the things that the whole world did to try to stop the conflict between Russia and Ukraine was put embargoes and sanctions on Russia for oil exports. Well, what's Russia doing? They're essentially whitewashing their oil through Venezuela, right? So all this is happening through Venezuela, but people just look at it and say, oh, U.S. is being expansionary. No. One, we don't need Russia, Iran, and China setting up, a 30-minute flight from Miami. We don't need that. This is kind of Monroe Doctrine kind of thing, but even more so, Trump is saying, not in our hemisphere, not over here. Stay out of our space. And that's good for everybody. For Venezuela, there's no way that anyone can say they're not better off working with the United States and the rest of the Western world versus just China, Russia, and Iran. Things could not be clearer. Just look at how the lives of the people, look at how their economies are going, look at the freedoms they have. It's just very clear. Right now, Venezuela has to sell all of their oil at below market rate, where now we're going to be paying market rate for their oil, right? They don't have the ability to do all the refining for it. In the United States, we're set up for HFO refinery. So that's what Venezuela has. They have sour crude. And right now everything's kind of deteriorated there. What's better for Venezuela? To have Exxon, BP, Shell go in there and fund jobs for Venezuelans, or to have, a third of the production they could have and less employment? I mean, they have something like 200% inflation every year, right? So it's not even if you look at it from this, it's objective that it is better for them to work with us and the rest of the Western world. And it's better for us too, because we don't need to have our enemies setting up with a 30-minute flight away from the United States. Greenland, the reason that's so strategic, you're right, it also rare earth minerals is great, but you have China, you have Russia, all of them are trying to go in there. And as we know, as more and more of the ice melts away in the Arctic, that is going to become a huge shipping path. That will become the next Panama Canal, the next Suez Canal. And whoever owns it or whoever controls it is going to have huge dominance and power across the world, right? That will completely redefine where shipping lanes go through. And right now you have China and Russia making huge efforts into expansionism over there. And so it's not, is expansionism good or bad? They're already doing it. They're already expanding. All right. China is actively trying to threaten Taiwan. China's actively attacking the Philippines and going in there. Right. We see what Russia's doing with Ukraine. So for us to go and liberate a country of their second dictator in a row, and for us to talk to Greenland, we're not going in there with brute force. We're not in there violently. We're saying we'll pay you. How much? Because it's in our best interest. It's in your best interest. It's in the rest of Europe's best interest for the United States to be in there than not. So we are doing things, I would say, in a proper way. I don't think expansionism is bad. Everything has a price. No matter what you think, everything has a price. It just does.
Well, what do you think about Trump saying we'll either do it the easy way or the hard way? Did you hear him say that yesterday?
I think
is it just Trump's rhetoric? I mean, he tends to be kind of bombastic. I think it was probably a little bit of a chess move. I think he crafts his statements in a way to leverage an outcome. I'm not sure he's always serious. I think he's serious. He's not. What was the phrase somebody's used before? You know what I'm talking about? He's serious, but not literal or something like that.
Well, here's what I think about that statement. One, if people still don't understand how Trump works, then that's on you. Then really, he's not the idiot. You're the idiot. And I know that's hard for people to think, am I the idiot? And if more people thought that way, like, where am I wrong? Am I being the stupid one here? You would do so much better at work, in your family, in your trades, in your investing. You do so much better if you just thought, like, where am I wrong? Where am I being stupid right now? But people don't like admitting they're stupid. People just want to be keyboard warriors always. When Trump makes any threat, he's doing two things. One, especially when it comes to a threat like that or to Venezuela, is he's doing the number one thing that the U.S. military does: projection of power. Projection of power keeps peace in this world. That's why we have all of these vessels and bases all over the world. We're projecting power. We're letting the world know, yeah, we're here. We're here. That's why they call us the policeman of the world. A lot of people don't like that, but I think police are pretty good for our society. And that's why we see a lot of conflicts not happen. So projection of power is a very core tenet of our military, and our commander-in-chief needs to be able to express that projection of power. And when you say, hey, there's a line you don't cross, if you cross that line, you need to take action. And Trump's really good about that. So when he talks about we'll do either the nice way or the hard way, I don't think you could take him literal in the sense like we're going to invade, we're going to do what Russia did to Ukraine. That's not happening. If there's one thing, again, that in 6-7 years of Trump that you still don't understand, he does not like boots on the ground. He does not like wars. He wants things done swiftly and quickly. And I think with Greenland, I think he's literally just talking about, like, we'll make you an offer you can't refuse. Like, it'll be impossible. Or he'll just keep ramping up the rhetoric until he gets what he wants, which tends to work for him. So I don't think it means he's going to go invade. I think that's just people's worst nightmares happening. He has never given any example where he'd go in and invade. He has not expanded into Venezuela. He's doing the best thing that could happen to Venezuela. Every person in Venezuela is celebrating what happened to Maduro. Everyone. No one is not. The only people that aren't are people in the United States, liberals in the United States. That's it. All right. And then what's he do after he does that? He immediately gives them access to the best market, the best economy in the entire world. Like, that's like me sitting there saying, hey, Greg, you just started a new business. You had a horrible CEO. I'm going to get rid of that CEO, and I'm going to give you the biggest client you've ever had in your life. In fact, the biggest client in the world. Yeah. Is that a bad guy?
No, and Venezuela's stock market is up like 200% in the last week as a result of it.
Yeah, it's people just let their politics get in the way, or maybe it's not in politics. Maybe they just understand, like, hey, this is what the news told me, so this is all I know, but they don't see the bigger chess game.
Right.
So to me, there's a bigger chess game at play here. I personally do think a lot of it is good versus evil. And that doesn't mean that the people that I think are on the evil side are all evil, but they may only know one side of things, or they don't know the whole picture, But in general, to me, oppressing people, having less restrictions, less freedoms, you're just never on the right side. Silencing people, you're never on the right side. Violence, you're never on the right side. It's just, that's just my opinion. Whether it's Cuba or North Korea, not letting your people leave your country, you're just not on the right side. I think that's objective.
Yeah, that's really interesting. Let's talk about the autonomy.
Yes.
Autonomy
Let's talk
hearing.
Tesla.
Yeah, let's talk Tesla and the autonomy hearing. Can I set the stage a little bit for it?
You set that stage. Let's ride right up onto that stage.
So I think this is extremely interesting. The NHTSA has there's safety regulations for every vehicle, right? In the 70s, NHTSA made an exception for these safety regulations as an effort to promote technology improvements. And what I mean by that is the safety standards will be something like, you have to have these types of brakes and these seat belts and whatever. But they made an exception for each manufacturer to sell 2,500 vehicles a year that don't meet those standards, but those exact specifications, but have similar or higher safety standards in those cars. And those are to promote things like regenerative braking or different technologies that don't exactly fit the regulations, but that are an improvement over the technology that's built into those regulations. So I think that's really interesting. And since the 70s, manufacturers have been able to sell 2,500 cars a year based on that exception. Now, recently, autonomous vehicles are taking advantage of that exception. The problem is that it limits each manufacturer to 2,500 vehicles a year. So the hearing that's going to be on the 13th is about expanding that exception to 90,000 vehicles per manufacturer, which will be a really important timing probably for Tesla's expansion of the robotaxi network.
Yeah. So again, just looking at the chessboard of things, because I think you always need to think about, you need to zoom out. How do we get here? All right.
Right.
And this ties back to midterms. Okay. Elon was just at the White House. Elon, Trump, Melania just had dinner. 1 week later, all of a sudden, hey, we have this hearing set for the 13th. Coincidence? I don't know. Is that sarcastic?
Yes.
Okay. I was about to say, 90,000? Why 90,000? Maybe that's because that's normally how the ramp starts, about 90,000 on year one. Maybe. Maybe this happens right after because Elon has set a start date for April for Cybercab production, and he doesn't need this annoyance of some silly regulation stopping him. Maybe. Or maybe it's all coincidence. Maybe it has nothing to do with a kind of quid pro quo. Trump needs to make sure there's peace with Elon, and guess what? Trump needs funding to help ensure that they win midterms. Maybe it has nothing to do with that. I don't care at the end of the day, what happens in midterms right now. I care more about what's happening here and that dinner meeting. And I mean, there was a lot of people there, but it was only 3 of them at a table together. To me, that signaled peace, truth, and that we will have a 90K ability to build these vehicles by April. So I think, to me, in my mind, right now, I have no way to prove this. I think it's signed, sealed, delivered. They're not going to be limited come April when they start production.
I think the interesting question is, will Congress see autonomous vehicles as equivalent or greater safety standards than typical OEM ICE vehicles?
This does not have to go through Congress. This is all up to the Department of Transportation.
All right. Well, same question then. I wonder if they'll see enough evidence in the safety of autonomous driving that they will find that it is equivalent or safer than a traditional ICE vehicle.
So Sean Duffy, DOT Secretary of the Department of Transportation, he was out at Giga Texas a couple months ago looking at the Cybercab. This past week, we had several senators out there looking at the Cybercab production line. I think it's, I mean, you drive FSD
All the time.
all the time. Like to me, and mind you, I know some people, you have a Cybertruck. I know some people with the Cybertruck, it's, you know, they have kind of these like little things that are quite good.
It's pretty amazing.
Oh, okay. So
Yeah,
even use, okay. I was saying on the Model Y, it's perfect. Like it's flawless. I have not had, like if I take over, it's because like I know there's a pothole. I want to avoid the pothole. If I take over, it's because, well, it parked into my driveway, but it didn't go into the garage, right? That's my, I don't take over at parking lots. I let it park. I don't take over at Brickyard. At Brickyard, believe it or not, I type in Brickyard, Greg. This is the gym we go to. It goes into the back and it backs in to
the secret spot?
Yes.
No way.
Yes.
Do you think it learns?
I do. I think it did learn. I don't have a pin drop there or anything. I think it recognized my driving pattern behaviors. Because a good example, without any updates, at first it would pull nose first into my driveway. And after about a week and a half, it only backs into my driveway now. Like I do think that there's some reasoning learning that's occurring within the model.
Makes sense.
Yeah. Well, you're gonna have to have those abilities, right? Like if I always take, you know, a certain street to go to your house versus another street, it should learn to take that street as the default path, right? Like that's pretty common sense. Like not that hard.
Yeah.
But yeah, so I think the 13th is gonna be a big deal. I think it could have good, depending on what comes out, you know, any kind of headlines or anything, it could be a binary moment for Tesla and the stock. That's one of the reasons why I'm not putting on any new covered calls. I'm actually working on a lengthy post for all my subscribers on X, kind of talking about this, but I've essentially been scaling out of all my short calls on Tesla because they've become very profitable, but also because we've now pulled back. I think in the post I said like 10%, but really all the way down to 426, that would have been a 15% pullback from 498 or whatever we were at. And that's just not a type of environment I want to be selling calls in. I don't want to be selling calls. And that doesn't mean that Tesla won't keep going down. It could obviously keep going down. But to me, the risk reward isn't there.
See, I have a completely opposite perspective of that.
I know you do.
but there's our portfolios are set up a little bit different right now. For me, Tesla has proven over the last several years it has the ability to make massive swings one way or the other, and I want to protect the value of my portfolio, so I want to keep those covered calls on at all time. I keep rolling them down. I'm back down. 3 weeks ago, I was at 485, and I was like, I think the stock was sitting right at 485. And I talked about how I rolled them out in time to the next month's expiration, I believe, and a little wider for the same premium. And I've been rolling them back down since then. And now, again, I'm at 485. But for me, I'm like, okay, Tesla's has been going down the last few weeks, about 10% pullback. But again, I want to go back up to 485. I'm bullish on it. Go ahead and take my shares. If we start trending back up in that direction, I've got cash on the side to do other things. I'll sell, I'll buy some calls, or I'll sell short puts. And then if I get assigned, no problem. I've got the cash to get assigned. So for me right now, until we start seeing significant revenue from robotaxi and kind of the economics of Tesla start to turn around, my goal is to protect the value of my portfolio while still being bullish on Tesla.
I like it. Yeah, I didn't tell you this. I bought 500 shares of Tesla on Friday, or I got assigned 500 shares of Tesla on Friday. So I'm getting pretty bullish here, which is so, we started off on this episode. I've been very cautious to start the year, but now I've been loading up on shares.
I was almost assigned 200 shares on Friday at 430, 2.5. And then I rolled them to next week. So I was up about 50% on them. I think we were at 430.
Oh, you rolled early, didn't you?
435. Yeah.
You had to have rolled early because you wouldn't have rolled otherwise.
No, yeah, I rolled a little early. But I was just like, well, collect an extra $800 in premium and get assigned next week if that's what's in the cards.
Yeah, no, and that's exactly what I do. Like I'll keep like if I can collect more premium, then I will until, especially if I want shares. The only reason I didn't do it this time is because I wanted the shares. I want to have the shares in hand, and I don't know why. Again, like I don't like doing things based on feeling.
Yeah.
But I felt more comfortable having more shares than not right now, and I want to take assignment.
I had short calls at 395 a few weeks ago when we were a little lower.
Short calls. You had short.
I had short puts at 395.
Okay. Say, like,
and I was like, oh, I'm gonna get assigned at 395. Like that's great, and it just didn't happen. I was a little disappointed.
Yeah, no, don't you hate when that happens, especially when it's like right there, and you're like, come on, give me the shares.
Just bought the shares. Yeah.
That's also like the difference in mind state of mind when it's you have the cash and you want to be assigned, or you have the shares, like, yeah, take them at that price. You know, like I was like that with Meta. I was like, yeah, 680, they're all yours. Take my shares. You know, but it's a lot different when you're naked, or you don't have the cash, or you don't have the shares, and you're like, all right, relax, stock, chill out. We don't need to be this aggressive. You know, that's kind of the nice thing about when you're cash secured or it's a covered call is those kind of tail risks, you don't really mind them.
You don't mind them unless things go drastically against you.
Well, how do they go drastically against you? On a covered call? On
a covered call, not so much.
Yeah,
on a short put.
Yeah.
I'm talking specifically about a short put.
Yeah, that's fair.
Yeah, I mean, you'd be disappointed too if you had a short call on and Tesla rips. You've got 3 or 4
but it
weeks
wouldn't hurt
until.
me.
No, it wouldn't hurt you, but you'd be disappointed.
Yeah, of course. I mean, at the end of the day, you're always disappointed if you left any money on the table.
There's always a gotcha to the gimme, right?
Yeah. Okay, Jim. So let's talk about Nvidia and Tesla. So Nvidia came out with, I guess, their FSD competitor. Did you see
Tesla
this?
Killer?
Yeah. Did you see this?
I did see it.
And what did you come away with?
I think it's good. I think it's good because as other manufacturers really start taking autonomous driving seriously, that will be good for robo-taxi expansion for Tesla. It'll be good for pushing regulators to accept the technology, to adopt the technology. The faster it's adopted, the better it is for Tesla. Tesla is by far the leader in the space, right? I think the biggest issue for other manufacturers is going to be the data. Tesla has billions of miles at this point on FSD driving, and it's a long tail problem with a lot of unique scenarios. So I think, Nvidia coming out with a platform and a chip that other manufacturers can build into a vehicle, like, okay, but it's going to take you years to build that vehicle. It's going to take you years to figure out how to implement that chip in a vehicle. Everything from, they can reverse engineer a Tesla to some degree, but where to put the cameras, how to put the cameras, creating the vehicle is hard enough with that technology inside of it. And then you have to go and train the technology. You have to train that computer. And will that computer at the end of the day, that processor, be the right solution for a manufacturer? Maybe, maybe not. We've seen Tesla go through 4 iterations so far, figuring out, okay, I need a camera on the front bumper. Like that wasn't around until hardware 4, right? So there's all kinds of complexities to it. I think it's great for the autonomous space as a whole, and it's going to be great for Tesla.
All right, here's my hot take. I think it's all Fugazi. I think it's all BS. I think it's all vaporware. I think that Jensen was being a salesman on stage. He said a couple things that borderline were dishonest. Played a little dumb on the end-to-end, as if Tesla wasn't doing it, as if they weren't the first ones doing it, let alone really the only ones. Because guess what? Even with Nvidia, they're, again, I forget what it's called, Alpamayo, I think. It's not end-to-end. they have two stacks running on it. They have a heuristic-based stack, and then they have a neural net-based stack. And the heuristic stack is there in case the neural net stack does something that is improper, right? And they only have 170,000 miles labeled. The rest of it is synthetic data. And it seems very clear to me that this was a sales pitch to other auto manufacturers.
Did you see that Biden tweeted, Jensen, you led and it mattered?
I don't think he actually. Okay, I was going to say. I think AI just really got you.
He's the leader in the autonomy space. You don't know that? Yeah. He led and it mattered.
But I think this was just one big sales pitch to give hopium to Rivian, to Ford, to GM. And I don't even think they're going to take it. GM's doing Cruise. Ford's doing their Blue's Clues. Rivian's trying to do their own thing. I think all of this is Fugazi. I don't think any of it's real. Nvidia has been having a self-driving stack for years now. And where is it? Show me where it's at. No one has seen it. And I really don't think it's good for the industry. I really don't, because it's going to be wasted capital that could have been put somewhere else to be more efficient. As far as I'm concerned, Greg, in the Western world, maybe the whole world, it's over. It's done. No one's going to be able to compete with Tesla. All right. Not even Waymo. I know people like Waymo. Listen, we're driving our vehicles everywhere right now. Tesla doesn't have road taxis where we live. Waymo can't do that. All right. That's one. Two, Tesla is not only going to be the Apple iOS, they're also going to be the Android. What do I mean by that? Apple iOS, closed system, vertically integrated, right? The most profitable. We all believe more or less that that's going to be Tesla, right? All right. Who's got better scales of economy? Who's got the most affordable EVs in the world? It's Tesla. So they are the Android at the same time. They are the most cost effective. So they're the Android and they are the Apple iOS. The better analogy would be that Tesla's going to be a Google. And Waymo will be Bing, right? So I don't understand how and this is why I think it's a waste of money for other OEMs. How are they even going to launch? If Tesla is everywhere and you decide to launch your company with your robotaxis, I can just underprice you all day and you can't do anything about it. How do you ever get off the ground? How do you ever get the profitability?
Is the only way.
But you can't underprice me. It'd be impossible. I'm completely vertically integrated. I have no middleman. And I have a camera base.
You can't do it profitably. That doesn't mean they won't try, right?
But even then, there has to be a path toward profitability.
Right.
Otherwise you won't try. So to me, this is going to become a winner-take-all market. I think it's going to be that ubiquitous. That's not to say that there won't be a Chinese competitor, right? Because even though Google is Google, you still have Baidu there because Google's not allowed there. They still have their own versions of Facebook and whatnot, right? But that's literally just keeping it. I mean, it's no different than here in the States. We keep out Chinese EV vehicles, right? Because Ford, GM, they would be decimated. So I think this was Jensen trying to get as many sales as he can to try to give hopium into the market. Hey, you still have a chance. Look at this demo we put together. But I think it's Fugazi. I think it's vaporware. I don't think it's going to go anywhere. Mark my words.
Yeah. I mean, I think you're right. I think Tesla has such a lead. I think we all believe that Tesla is going to win the space. I'm sure there will be a number two player. Most markets have 2 or 3 players. It doesn't mean they're all going to be the same size or carry the same weight. Just look at search right now. We have, pre-Grok and ChatGPT, I guess anyway. But you've had Google has dominated forever. Yeah, there's multiple players in the space, but who uses Yahoo search? I don't.
No one does.
Exactly.
Yeah. Maybe that one old guy who's our biggest fan.
Well, one difference though is Google has historically not been political, and so they've been able to be friendly with everybody in the United States. Tesla does have some political turmoil. So that may be an opportunity for another manufacturer if they can compete technologically to get a foothold in the space.
Greg, if there's one thing that bridges or supersedes red, blue, liberal, conservative, anything like that,
It's money.
Money. Money is at the end. Listen, all these people who are extremely liberal, I don't see them not shopping at malls, not buying from, not using their iPhones, not using, what's that clothing store, Temu? Or no, not Temu, Shein. I mean, like all these things, like it's just not true. I mean, you can sit there and you can try and vote with your dollar, but the truth is people care too much about their dollar to actually vote with their dollar, meaning to abstain. The only reason you're going to abstain from one company is if there's someone you don't like there, but there's an alternative. There won't be a cost-effective alternative to robotaxis.
Right.
There just won't be. There isn't a cost-effective alternative right now to full self-driving. There's only one full self-driving out there. It's Tesla. No one else has it. So I think it's a winner take all. I don't think there's a chance. I think at the end of the day, if people you can be the most liberal person and hate Elon, think he's the devil. And we know someone like that, and she drives a Tesla. Okay? So like use that as a litmus test, right? But at the end of the day, it's the safest car in the world. If you can get to a place where you only have robo-taxis and you don't need to have a car payment, you don't need to have an insurance payment, you don't need to have maintenance, and you can get from point to point at a fraction of the cost, who's going to say no to that?
Right. Those are good points. I want to make sure we get an opportunity while we still have time to talk about
small accounts.
Yeah. Somebody, a listener commented on our YouTube channel asking how we would trade differently if we had a smaller account. I made a post on X, I don't know if you saw it, Nick, where I kind of broke down how you would trade differently with a small account than a larger account. But we should talk about this for the audience. I'll just kick it off here. The first thing I would say is defined risk strategies are going to be your bread and butter.
Can we establish what a small account is?
Well, a small account can be, I would say anywhere up to 150,000. What I would say.
So you're saying 150 and below?
I would say 150 and below is when you need to think about the things we're going to talk about here as a smaller account.
Okay. And what would you say the lowest amount? And I'll share what I think too.
Yeah. So typically you can expect to make 1% to 4% on your portfolio a month.
I meant what's the least amount that you can have where you think it's okay to trade with?
Well, that's where I'm going with, right? So if you had a $1,000 account, you could expect to make between $10 and $40 a month. That's probably not enough to trade with, right? So I would say maybe $20,000 account. That would be that'd be $200 a month to $800 a month. That's not bad. That's worth your time to trade, I think. So I would say maybe about $20,000 account. What would you say?
To me, I would say we're close. I would say anything between 25,000 and 100,000, I would consider small account. Obviously, some of those are smaller than others. And I would say if you don't have more than 25,000, in my opinion, you shouldn't be trading. You honestly, if you don't have more than 25,000, before you start trading, make sure you don't have any credit card bills. Make sure you have a little money set aside in case of an emergency. Make sure you don't have any loans that aren't a mortgage or a reasonable car loan. And even then, try to pay off your car. Make sure that you're investing into stocks first, and make sure you have a basis for a decent portfolio with equities. Once you've done all that, then think about trading. And
be confident that you're not going to need that money in the next 6 months or so.
Yeah.
6 months or a year. You don't want to be trading with money that, if you have your alternator goes out in your car, you're going to need that money to fix your alternator, right?
Yeah, I think the order of operations should be watch Dave Ramsey, listen to what he says. Once you've accomplished that, go listen to the Money Podcast guys who talk about creating wealth and where to save and index funds and all that. And once you've gotten to a point where you're kind of adhering by their rules and you have at least 25K, then come to us. Right? So like there's an order of operations. Get your financial house in order, put some money aside for emergencies, have capital allocated to equities or S&P, whatever. I personally, I'm not an S&P 500 guy, but I like to pick stocks I believe in. But whatever it is, get a good basis of equities, and then it's time to come to us to learn about trading, where you can amplify your returns.
Yeah, and this is not abstract advice. This is not us telling people to do something that we wouldn't do. I graduated from law school with $200,000 in student loan debt, and I did nothing for the next 4 years other than pay off that debt. I didn't invest, I didn't save. 4 years after law school, I started dead broke at zero. And then I started saving, investing, and then eventually found my way into trading options.
And again, different path, but I was saving money when I was 13 to 14, 15 to buy a car. My stepfather introduced me to investing in stocks. Before getting into debt and buying a car, instead I went right into the markets. I went to a military academy where my entire tuition was paid for me because I was able to get in. So I came out without any debt, and right away I bought a house, I bought a car, and then I started investing just into the stock market. And it wasn't until years down the road before I even heard of what options were and started trading.
Yeah, so this is a fundamental path that you don't want to skip those steps. You don't want to be doing this with consumer debt.
Yeah.
You want to get your house in order before you're trading.
We're not a get rich quick podcast group course. That's not what we're about. We're about once you've done all the things in the right order, then you come to us and we can help you amplify. So anyways, didn't want to go off topic. I just want to at least, because we're talking about smaller accounts. I just want to make sure that those people who have smaller accounts are not skipping steps.
That's sound advice, and it was important that you brought it up.
All right. So where were we?
So the first thing I would say is your bread and butter trades are going to be defined risk trades. Why is that? Because they require less buying power. Honestly, that's the only reason. Yes, they are a little bit, there's less risk in them on at a practical level. If you're following mechanics, there isn't really less risk out there for them, but from a perceived risk perspective, your risk is limited, and that's why brokerage accounts will require less buying power for those trades. But with that comes an increased responsibility for risk management for several reasons. The first one is because defined risk trades require less buying power, you are able to put on more trades with the size of your portfolio than if you were putting on undefined risk trades. And the reason why that's risky is because if you were going to put on if you had a $50,000 account and you wanted to put on undefined risk trades, you could put on like 4. But if you're putting on defined risk trades, maybe you can put on 30. And if something goes wrong, those 30 are going to accumulate way more losses than those 4 will. Because like I said, the actual risk when you follow your mechanics is about the same in a defined risk and an undefined risk trade. So you have an increased responsibility, increased risk management. You need to be more careful about what you're trading, because what comes along with trading with a smaller account often is trading cheaper stocks that are less established. They're not like blue chip stocks that move slowly. We're talking about stocks that are maybe they're newer startups that have gone public that can swing wildly. They can go out of business. As a trader, you're always taking the risk of being assigned if you're selling short puts, and you don't want to I'll be assigned on Tesla, but but I don't want to be assigned on MicroStrategy, right?
I don't think so.
Yeah. So, as with a larger account, you can trade names that it doesn't matter their stock price. You have the money to cover it. You have the money to trade these larger names. And I want to own Palantir. I want to own Tesla. I want to own Nvidia, but I don't want to own MicroStrategy. I don't want to own some of these smaller names that I see people trading a lot with smaller accounts. So my advice there, and then I'll turn it over to Nick, would be trade on those bigger names, but defined risk strategies so that you have comfort that if you were to be assigned a short put as part of defined risk strategy, you would be okay owning that stock and not put yourself in a risky position of owning something you really don't want to own.
So let me start off by once again saying that if you are a small account trader, meaning you've got between 25,000 to 100K, and you have your house in order like we discussed, my first advice would be and I know this, I'm going to sound like a grifter here, but sign up for our options crash course on the 31st, or we'll have other ones, because you have a small account, you can't really play with learning on your own. And it really doesn't make sense to learn on your own when we can teach you what we mean by this. Greg just said undefined risk, and those strategies are like iron condors, put spreads, call spreads, right? Diagonals, right? There's all kinds of things, but you don't need to learn those on your own. We can teach you, because what I see too often is people learn, iron condor, defined risk. Let me go place a trade now. But they don't understand everything else we've been talking about. They don't understand, is this the right time to place a iron condor? Where do I put my wings? How wide? Do I put both on at the same time or separate? How do I know when to take off? There's so much more than just understanding what is the strategy. So I think the first thing I would say is, part of me wants to say just to be agnostic, like go take any other course you want, just go learn. But at the same time, I don't think other people do as good of a job as we do. I think that we aren't going to BS you. We're going to sit here and talk to you about the real world implications. What I don't like about a lot of these courses is they talk about things in a vacuum, in theory, on how things work, but they don't tell you the dirty, ugly truth of what the real world is like when you put these things on. Yes, we talk about that. We go over the theory of it, but we also talk about how you actually need to have your setup. How do you get all those, I talked about a layered approach. We like to have a layered approach. Well, the strategy is arguably the least important part of the layered approach. But do you have everything else stacked in your favor? And once you have everything stacked up, okay, now what strategy do I want to use? Like, it's kind of the last thing really to think about, but you have to make sure everything else is set up, because then you have options. Do I want to do an iron condor? Do I want to do a put spread, call spread? Do I want to go naked? Do I want to do less contracts and go naked so I use less buying power, right? So I think learning from, and again, maybe I will say, if you can find another course that's not us, that will actually teach you like in a real world and give you the real dirty, not trying to just be the most polished thing out there in the world, but give you the legit perspective, then I would say that's a good course.
And it's not a black box. Here's the secret way system that I do it.
Yeah.
We don't teach that. We are teaching how we believe to trade correctly. They're not secrets. They're just knowledge and experience of what works.
Yeah, with the idea of teaching you how to fish.
Exactly.
Right? We don't want you to have to come back, right? If you come back, it's because you're like, hey, I've learned this. Now you talked about 0 days. I want to learn about that. Or I want to learn how to do advanced management strategies, right? Okay, then we can talk about that. But it needs to be different topics that you come back to us for. But going back to the smaller accounts, my biggest message would be to learn, take our course. You can, I know Greg said, you won't be doing a lot of blue chip stocks, but you can still do a lot of fun. You can still trade Palantir. You could do Palantir naked. You can do Netflix naked. I mean, you can obviously do defined risk, like Greg's right. Like, your smaller account, you're learning, you should be defining your risk for sure. But I'm just saying, like, as you're learning, you also want to take some shots. You also want to learn how to trade naked, because at the end of the day, your probabilities are just going to go way up and they're easier to manage. But these are smaller companies now. Netflix had a stock split, so it's like a $90 stock now. Palantir's like 170. Even Nvidia, I would say, is probably good for small accounts. So there are stocks out there that you can trade on that have good premium, that are good to learn and trade on. But knowing the given strategy is literally the last step of everything. And I can't stress that enough. You need to understand the whole picture, how the game is played, how they actually work, how to know, should you be buying or selling? Should you be selling or buying? What's the order of operations? If you don't know that, then you're just going to blow up your account, which is the last thing I'll say. The worst thing that I see frequently about small accounts, Greg, is that people tend to have a YOLO mentality. We're like, well, it's only this. Let's put it all into one trade or two trades, or let's increase this amount of contracts. If I blow it up, it's whatever. You know, like it's almost like, because it's a small account and we say small account, which I kind of hate that word, small account. It makes people think like, well, if I lose, it's not a big deal. It was small. And I don't agree. I think small accounts are important to do things the right way, because that $25,000 account, that $30,000 account can quickly become 100, 150, 200,000. And once you at least get to 100,000, to go from 100,000 to $1 million is a lot easier than going from 0 to 100,000. It's a lot easier. You don't have to have as big of a return, right? And to go from $1 million to 2 million, it's even smaller, right? So that's how compounding works. So you want to get to your 100,000 as fast as you can in a safe, smart way. Fast means don't blow yourself up. Don't keep going back to zero. That's what fast means. So that's kind of my message. We have all kinds. We just can't get into it in a podcast, guys. We're already over. We're trying to stay under an hour this time. We're already over. So it's just, this is not the forum to be teaching. The teaching is our crash course, and the other ones we'll put on.
Yeah, and it's hard. It's almost hard to express the importance of understanding the theory behind trading options, because the mechanics aren't that complicated. They don't take that much time. You're not building something like that's complicated. The trading part is easy. The theory behind it, the decisions behind it, are what separates somebody that can trade profitably and that won't trade profitably and will lose their account. And we don't want to see that. I don't want to hawk our course either, but the cost of $1,000 or $1,100 to learn how to do this properly is going to save you so much money. There was somebody that was commenting last week on our last podcast episode. He was asking me questions about, why do you do a 45-day or 21-day? And he said he's made a six-figure mistake. And I was like, this is exactly what we teach in the course. You should do the course. And he's like, well, I don't know if I'm quite ready for it. And I'm like,
if you're touching options at all, you're ready for it.
Yeah. And spending $1,100 to learn how to do this properly, compared to making a six-figure mistake that's going to cost you $100,000+. It's an easy decision. Like, you don't have to take our course. Go take another. I don't know if there are other courses like the way we do it, but just get the education. The cost of it is so negligible compared to the size of the mistakes that you can make without it. And how do I know that? How do we know that? Because we made expensive mistakes. I wish I had taken a course like we are teaching.
Yeah.
Before, as I was getting into options.
You know what the problem was? Like I don't know, maybe we should cut it off here, but I would say, like, when we were first getting into options, when I was first getting, like, I started off by reading a book that it was just theory based. Everything was theory. And then even now, if you go on YouTube, everything's theory. Like, yeah, I can show you what a call is. I can show you what a put is. I can tell you what your profit loss zones are. But that's like going to school, going to college, understanding how the law is supposed to work and all that, taking your bar, and then you go out into the real world as an attorney and you're like, all right, this is by a little, I mean a lot different in reality, right? Things are definitely more open to interpretation, and it can be not necessarily who's right by the law, but who makes the best arguments rather than just what, the books say. And I feel like that's how it is with trading, where there's plenty of theory out there. There's lots of people tell you what a call option is, but there's not a lot of people that operationalize it and tell you what you actually need to focus on, what you don't need to focus on, and how to put everything together and how to mechanize it.
Well, you have to start with the information.
Yeah.
Right? You have to start with learning what calls are and puts are and delta and gamma and all those. And then you have to develop experience. You can either develop experience by making expensive mistakes and trying to operationalize it yourself, or you can learn from people that have experience doing it, and they can teach you how to not make those mistakes, how to operationalize your trades, how to develop mechanics, what strategies work, and what market conditions, what to do when earnings are approaching. There's a million decisions, and you have to have that experience that you develop either by making tons of mistakes or by learning from somebody else. You can't learn that on YouTube.
You know what it reminds me of? It's like that, you have a plumbing issue. You have a big plumbing issue. You don't know what to do. Your toilet won't flush. Your sinks won't turn on. Your shower won't drain. It's like everything's backed up. You're like, oh my God, what do I do? And you call a plumber. And all of a sudden that plumber looks at it, goes outside, 2 seconds, flushes out a drain line, comes back in. All right, I'm done. It's $1,000. I'm like, $1,000? It took you 10 seconds. What are you talking about, $1,000? You're paying for the experience.
Yeah.
You're paying to solve your problem with the experience and have that expedited. Otherwise, how much time would it spent you? How many trips to Home Depot would you have gone through? How much money would you have thrown out the window to not solve the problem? That's what you're paying for. Yeah. That person, you didn't pay him for the 10 seconds to solve the problem. You paid him for the years of experience he had that led to him being able to solve that problem in 10 seconds.
I think Nikola Tesla has a famous story about that. When he was like fixing a dam, there was like a generator that was making a buzzing sound or something like that. And he like slept over at the dam for like 3 weeks and then walks out and charges them like an outrageous amount of money. And they were like, wait, it was just the generator buzzing. And he was like, yeah, I'm charging you $1 for fixing the generator and $1,000 for the experience, something like that. I'm butchering the story, but it's something like that.
I didn't know that.
Yeah. Maybe somebody told me that. It's not actually true. I don't know. I'll try and find it.
But anyways, so that's how I see our course. Again, like you're free to make your own decisions, obviously. We live in a free country, the greatest country in the world. So do what you want. But if you want to have the plumber, we're the plumbers.
Right.
And on that, let's leave it at that. Greg, thanks again for another great episode. All of you, we'll see you next week.
See you next week.
Cheers.